24 seconds away from the opening bell this morning. A brand new trading week just around the corner. Good morning. Futures positive 0.2% on the S&P. On the Nasdaq, basically unchanged. On the small caps, the Russell up 1/3%. From New York, your opening bell just about to ring. There you go. Switch up the board and get to the bond market. 10-year yields look like this. Yields higher, 9 basis points to 2.83. A 0% on a 10-year. The curve just a little bit steeper here. Last week, 2-year yields lower, much lower across Thursday and Friday. Downside surprise after downside surprise on the data front, and a wrong kind of upside surprise on jobless claims. Pair that with PMIs, and yields were heading south. They're heading north this morning. Euro dollar up 1/3%, 102.48. We've talked about this growing tension between weaker economic data, think of German business confidence, against the more hawkish central bank. Think of an ECB policymaker this morning teeing up potentially another 50 basis point hike in September. Crude bouncing back up 1.6%, a 96 handle on WTI, $96 and about 20 cents. We're about 40 seconds into this with positive 0.1%. Leading the way is energy off the back of that climb in crude. Energy up by 1.1%. Utilities a little bit more defensive. They underperform. We're down 0.2% there. Joining us for a look at the stocks around the opening bell, some single name movers. Here's Kelly Greifeld.
Well, you left off with energy. That's where I'm going to start. It's pretty muted reaction to the opening bell, but if you look under the surface, you do have energy front and center. You can see ExxonMobil higher by about 1% or so. You're also seeing some of the basic materials higher as well. That's good for some of the steel makers. We have Cleveland-Cliffs highlighted there. That's up about 1%. If you move down the list, though, it's not as green. You have Twitter down by over 1% just a few minutes into trading. Of course, Twitter had a disappointing earnings report on Friday. They blamed Elon Musk. Elon Musk fired back saying, "I'm rubber, they're glue," on Twitter, the website. I haven't heard that one for a few decades. In any case, Twitter shares down by about 1.6%. And NVIDIA falling along with the other chip makers. You did see Intel sign a very big contract for its contract chip making art. That's bad news rather for the other chip makers, NVIDIA being front and center there.
Can I just admit that I'd never heard of that particular saying?
Really?
I'm rubber, they're glue.
You've never been on an American playground?
Is that an American school thing?
That is very popular in about middle school.
It's your words bounce off me and they stick to you.
Exactly.
I had to get someone to explain that to me over the weekend.
There you go.
Thank you. Appreciate it. Kelly Greifeld. Looking ahead to a big week ahead for tech earnings and maybe not the schoolyard insults. I'd never heard of that, but okay. Kelly Lyons joins us now. Big week ahead, Kelly, for big tech.
Yeah, huge week ahead across just the 5 tech names, Microsoft, Alphabet, Meta, Amazon, and Apple. We're talking a casual $7.5 trillion in market cap, or roughly 20% of the S&P 500. So this is a lot of weight that could have the power to move the broader market. Of course, it's Alphabet and Microsoft first out of the gate today. For Microsoft, as usual, we'll be paying attention to that Azure cloud business. With Alphabet, though, the focus really is going to be about online advertising on Google, because if Snap is a reliable indicator, companies are pulling back on that in a big way. In fact, according to some estimates out there, the U.S. digital ad market likely only increased about 11% in the second quarter. That is a steep deceleration from the 58% growth we saw in the year-ago period. So that could impact not just Alphabet, but Meta as well. Meta is actually expected to post its first period of zero sales growth since the company's IPO about a decade ago. And for Alphabet, expected to see the slowest growth since the start of the pandemic in 2020. Meanwhile, Amazon is actually getting a larger share of its revenue from advertising as well, and it's expected to see the slowest revenue growth going all the way back to 2001, up just 6%, a dramatic cool down compared to the 30 to 40% growth we have seen throughout the pandemic. And of course, throughout the pandemic, they spent a lot of money investing in new warehouses, in the labor force. It's looking now like they may have overdone that, and profit's going to take a hit as a result. We're expecting net income to be down about 82%. Now, of course, they're trying to pull back on their workforce, one of a string of companies that is looking at slowing hiring or even firing in some places. I expect we're going to hear a lot about that this week, John, in addition to foreign exchange and all of those other big themes we're following.
Did you guys not have that line about sticks and stones may break my bones? You had that too?
Yes,
but
that was the more common one. I hadn't heard of the rubber thing
The rubber glue thing, it didn't make it our way.
Yeah,
that's all.
No.
It didn't make it down your way either.
It did not.
In Virginia. Okay, good to know. Kelly, thank you. PIMCO's Jerome Schneider on more serious things now, telling investors to build some dry powder in portfolios.
The right thing to do at this point in time is actually position yourself for a little bit of patience in your portfolios and have those higher cash levels, and perhaps take advantage of the higher relative rates that we're seeing in the front end of global interest rates curves.
Academy's Peter Cheer sounded the alarm on the economy. He writes this over the weekend: I am clearly in the camp that the recession risk is closer than we think and that it will be deeper and more painful than the market is currently pricing in. Pete, I'm pleased to say, joined us now because I like Pete, not because I want to read this anymore. Pete, I read this over the weekend. It was thoroughly depressing. Can you tell me why you think this is the case?
You know, a lot of what you were just discussing really falls into this. Is there was a lot of wealth created at these disruptive companies. Those individuals have lost a lot of wealth. But I think just as importantly, a lot of these disruptive companies, they were a huge engine for growth. They were advertising, they were buying chips, they were doing a lot of things because it was growth at all costs. And now that there's this fixation on revenue, I think you could see a slowdown from the spending from those people. I think you can see a slowdown from the spending of those companies. And that hasn't been factored in. That's a really new phenomenon. That huge wealth effect that we had that is dissipating very, very rapidly. That to me is what is going to turn what could be a garden variety recession and is going to make it hit us sooner and faster than anyone's currently thinking.
Pete, what are you seeing in the data that supports that view? Are you seeing that yet at all?
You know, we saw the PMIs come down. I think housing to me was one of the leading indicators, right? We wanted to fight housing, mortgage rates spiked. You're seeing nothing but bad data coming out of housing. And as PMIs come down, and you're starting to see anecdotally everywhere you look, hiring freezes, people laying people off, etc. So I think it's starting to show up there, and I think that's going to be the big surprise is when within a month or two, all of a sudden we're like, ooh, wow, this was worse than we thought, just like PMIs on Friday.
Pete, that's the intended consequence, perhaps, of tighter Fed policy. Are you seeing any unintended consequences of tighter Fed policy?
Yeah, I think, again, this goes back to, I think things have changed. One, we're way too dependent on finance and leverage and interest rates. So when they hike, it has a bigger impact. I think QE really did help inflate asset prices. QT is going to take that off. And then I do think they're just missing this recent wealth effect, whether it was crypto, these disruptive stocks, all great companies potentially, but there has been this wealth loss. And I think that's really going to get this ball rolling and make everyone very cautious. And it's that accelerant that's the problem, that the Fed is not taking into account, I don't think, in a very good way, because I think they're relying on traditional models and not thinking maybe outside the box enough.
So, Pete, you mentioned the R word. That's what I want to sit on just for a moment. We're often always thinking about where is the leverage. And what I've experienced over the last few weeks, in fact, the last 12 months, is someone again and again and again, people coming on this show and basically saying that there isn't a problem with leverage. Consumer balance sheets are strong, corporate balance sheets are strong. Where's the leverage, Pete?
So I think corporate balance sheets are generally strong, but I think it was these growth companies, right, where you had growth with no, concern about earnings, right? That's been taken off. So I think that was a degree of leverage. And I'm not so sure about the consumers. I think you're starting to see some delinquency show up. It's still at very low rates, but in some of the payments, and many still have moratoriums on student loans, et cetera. I think as those things start coming off, that again, we're going to see the shock effect. I think we already saw it once on the spending side where people had front-loaded spending. I think that's going to impact their credit, their willingness to spend going forward. So I think these are all really coming together. And unfortunately, it's going to come together probably this summer ahead of the elections.
And Pete, you could make the case the bond market's picking up on it. Yields came in pretty aggressively on Thursday, on Friday at the front end. This market, do you think it should focus on just yields coming down, supportive of risk assets, or the why of yields coming down?
Right. So to me, that's a big shift. Is for a while we got away with lower yields meant good for risk assets. And I think the two things that have changed were last year or so, lower yields were really a direct result of Fed policy. So there wasn't an economic reason necessarily. It was Fed policy. So now that yields are going down, but you can really tie it to economic concerns, I think you have to take cash flows down. So those should balance themselves. Again, I'm very worried about this disruptive technology stock where you had this ability to rise through anything. If you ran out of money, you could get more money, whether it's Series B, Series C, SPAC, IPO. That's been cut off for a lot of these companies, right? You're seeing valuations come down. You're seeing a big divergence, I think, between where companies think they should be valued and where private equity wants to contribute more. And that, to me, is a form of leverage.
So, Pete, tell me where you're bearish, much more so right now. Because this equity market's rallied off the lows of June. Yeah. Credit spreads have tightened aggressively off the wides of June. Where are you most bearish?
I'm probably most bearish again in this disruptive and big tech. I think they've had a really nice bounce. It was a great bounce. I think a lot of hedges got taken off. And I understand why we all want these to get back to where they were. It's, they're appealing. There's great growth stories. I just think that that's where the excess keeps getting pumped in, and that's going to keep kind of getting deflated. So we go through this, we blow it up a bit, we deflate, and every time we kind of get to new lower lows. So that to me is where I'm most concerned. I'm pretty good on credit. In fact, I like senior quality credit. I like CLOs, in particular at the senior tranches. I think rates are fine. We'll bounce around a little bit, but I think the highs of the year are certainly in. I buy yields. And I think we can take a little bit of a look at some of the commodity stocks because they've been beaten up pretty hard. So really, to me, it's going to be this big tech disruptive that, again, I want to take some of the air out of this recent rally.
Pete, how do you think the policymakers are going to respond to the situation that you think will evolve, will materialize?
What I would like to see is them become really data dependent and really force home on Wednesday that they're concerned about recession, that they're worried about that. What I'm seeing, though, is I think Treasury Secretary Yellen just came out saying she doesn't see a recession. The White House just published a blog trying to redefine what a recession is. So that tells to me there's still political pressure leaning on this inflation. And I think they've gone too far on that. So I could get very, very bullish if the Fed makes it sound like they are really going to balance this recession risk. If they come in all in on inflation, ignoring recession risk, then I think it's another big leg down for stocks.
It sounds like to me, though, Pete, that you think the forces have already been unleashed, that there's not much the Fed can pivot to, that it's too late. Would that be right?
I think they still have a shot. This week, if they really correct it, I think some of these forces have been moved. I don't think we're bouncing back to the highs anytime soon, even if they act well. But they have to start acting now. I think you go through this, you've got another month and a half or to the next meeting, and that's going to be too late.
How do they pause, though, Pete, with inflation still close to 9, 8, 7, 6? Even if we get to the end of the year and it's 5 or 4, don't they have to keep on going?
I don't think so. I think you're seeing commodity pressure ease, you're seeing some supply chain issues ease, and you're seeing consumer spending drop. So we've got to be forward-looking, right? Plus, a bunch of the hikes that they've already done are only starting to work their way into the economy. Traditionally, we always thought it was 3 to 6 months. I think that's been accelerated, but I think they should give this a pause and see where things come out, because I think they've been too, telegraphed, too aggressive, and they were so far behind the curve, maybe they even missed the curve. So I think they should really pause and watch this data.
Pete, we're all trying to trade the Fed pause. I know so many people are. Pete, one thing that hasn't come up at all, really, is when we look at lost decades, you can find them in the United States. You can find them on the NASDAQ. Of course, we're used to talking about them in Japan. Is there a risk here that even if the Fed pauses, Pete, that we could face the same situation in US markets? And I only ask that because it's never asked. Pete, we always think about the Fed pausing, we're off to the races again, here we go, another bull market. Is there a risk here that could be the case? That we enter this new market regime that, sure, even if you get a Fed pause down the road, you don't go back to what we used to have?
Yes, I agree with that. I think this kind of world of deglobalization or globalization is kind of ending. So I do think what we need to see real growth and real upside to the markets is this kind of reshoring. I think Yellen called it friendshoring. We've been talking about the concept of working with countries that are closer to you. And we need to rebuild our supply chain. We need to become energy independent again, fully energy dependent, both on sustainable as well as traditional energy. And those would be the catalysts for growth. And I think that's what it takes for me to get really comfortable that we can, avoid this sort of lost period of time. Otherwise, if we keep kind of getting lost in our own politics, not making good policy, not redeveloping our supply chains, I think we're going to kind of wobble around for a period of time.
And Pete, you're going to stick with us to work through some of the data we're going to get later this week. I want your thoughts on that GDP print this Thursday. Peter Cheer there of Economy Securities. Coming up, President Biden taking somewhat of a victory lap.
Gas prices are coming down. In fact, gas prices have fallen every day this summer for 38 days in a row.
That conversation, up next.
gas prices are coming down. In fact, gas prices have fallen every day this summer for 38 days in a row.
President Biden speaking on gasoline prices in a virtual meeting as he quarantines with COVID. Average prices at the pump have been falling every single day since its peak in the middle of June, still 32% higher than it was at the beginning of this year. Joining us now from D.C. is Anne-Marie. Hey, AMH.
Hey, John. Yeah, the president really wants to make sure that the public knows that prices are falling. If you look at his latest tweet on his Twitter handle, he does just that, and he keeps updating it. And right now, what we do have is gasoline prices hovering around $4.30. Gas Buddy actually says that prices across the nation are more closer to $3.99. So this is good for the president. Remember, this continues to come up in polls that inflation is the biggest concern. And then one of those big reminders, of course, is gasoline prices. You see that every single day if you're American driving in a car or walking across a gas station. The issue, though, Jonathan, of course, are the risks that are attached to it. Can the prices continue to fall or stay at a relatively average level that the president deems is acceptable ahead of the November midterm elections?
Anne-Marie, thank you. Mike McKee, ahead of the GDP print later this week, and we've already heard from Secretary Yellen over the weekend, Mike McKee, about whether they would or would not call that a recession. Mike, can you just frame what's going to happen this Thursday when we get that GDP number and how you think people are going to respond to it?
Well, people are going to look at the number, and those who think we're in recession could make an argument because we're likely to get either a contraction or a gain that is so small we really don't notice the difference. And then everybody's going to look to Friday and the prices, and the question is, does the Fed keep raising rates because prices keep going up and then push us into recession? One of the problems is we're not going to see the decline in gas prices make it into the PCE numbers this month because it all took place in July, and it's going to take place into August. But you look at that gas chart again, and you can see mathematically inflation is going to go down because gas prices are going to go down. It also has a psychological effect, not just the political aspect that AMH was talking about, but also the fact that people may feel like they can spend more money on other things now if gas prices keep going down, which would contribute to GDP. Now, here's something interesting. We aren't going to see gas prices reflected in this, but take a look here. The Philadelphia Fed and the New York Fed's latest indicators, the Philly Fed Index and the Empire Index, show that inflation, prices paid by companies, went down over the last month. And then that Michigan number, which sent the Fed to a 75 basis point the last time, has gone down. People think inflation is starting to fall back, and maybe that's because of gasoline prices. So there are some indications that maybe the Fed is doing enough on inflation that it will come down, and they maybe don't need to run us into a recession. The question is, where is that point?
Mike McKee, thank you. Looking ahead to the data this week, and of course the Fed Wednesday and beyond. Looking at GDP on Thursday, the estimates so far for the second quarter, positive 0.4% off the back of a negative 1.6%. The consensus view is that we get a positive view. That's the median estimate, but there are some banks out there looking for a negative print. They include Bank of America, TD, Deutsche Bank, Nomura, all looking for that second straight quarter of negative growth. Peter Tchir, I promised you we'd bring you back in to the conversation on this particular topic. Peter Tchir, of course, from Academy. Pete, can you just walk me through how you'd respond to that as a market participant if we got that negative print this Thursday on GDP?
So I'm not overly concerned about a negative GDP print. I think we might get one. But the first quarter, it was really inventory related and export related. So I'm not too worried about that. I'm going to be much more focused, I think, on the housing data. And really, for me, it's actually going to be earnings. I don't typically pay this much attention to earnings, but I want to hear what these big tech companies have to say. Are they still seeing that spending? Because I think that is going to what drives us for the next 2 to 3 months, not what happened the prior 2 months. So I think that's big. I do think this fixation on a few cents here and there on gasoline prices has just become almost insane. And we've got to be thinking about the bigger picture. I think the average consumer is much more aware of everything that's going on. And I think this housing price, if that starts coming down, we see weakness there. That's yet another reason actually for consumers not to spend, right? I believe it's 60% of American households own their home. I'm much more afraid as they've kind of deflated that to the point that starts impacting then a few cents here or there on gasoline. So I think politicians directing the economy fixated on one metric is a recipe for disaster ultimately and leads us to the wrong conclusions.
Pete, from what I heard this morning about driving and the demand season, it's meant to be peaking. Here's summer driving season in America. From what I heard about that this morning, it's because prices are so high that people have stepped back. So that's already having the impact, and that's perhaps why prices have been coming down. Pete, I'd love your view on tech. You mentioned it briefly. Which names, where specifically, and what spending? Is it cloud spending, ad spending? What is it?
I think I just keep looking at what were these disruptive companies doing? What did they need? They needed semiconductors. They needed web services. They needed all these things, and they were able to spend pretty aggressively because they did not have to worry about the next round of cash flow. If that's what I want to see, or is that now following up into the bigger companies who are selling that into those disruptive companies? So that to me is going to be the triggering point, I think.
Peter Chair of Economy Securities. Pete, great note this weekend. Even though it was very bearish, I enjoyed reading it, as always. Great work, Pete. Just awesome. Looking ahead to a big week ahead. Big morning for some people over at Morgan Stanley. Let's get you some breaking news. Here's Shonali Basak. Hey, Shonali.
Hey, John. You have a big move over at Morgan Stanley. That's the co-head of equities trading departing. That is David Russell, who has been at the bank for nearly 3 decades. Remember, Alan Thomas and Gokul Laria are still at the bank. They are overseeing this business. Morgan Stanley is the biggest equities trading shop on Wall Street. In recent quarters, remember, however, John, Goldman Sachs and JP Morgan have won a lot of share. And in some quarters, they're actually even coming in above Morgan Stanley in that business. So there's a lot of pressure on this team. There have been a lot of changes internally within the equities division. This has been a Morgan Stanley lifer, essentially. In the memo that Bloomberg Sridhar Natarajan had picked up from Ted Pick, who oversees the total business, they had really said he's worn the Morgan Stanley blue jersey for all of that time. But eyes now are on Gokul Laria and Alan Thomas, who will be leading this business, who were elevated in 2018 alongside David Russell to run this business and are just facing a very competitive time ahead.
Shonali, looking forward to your coverage of this developing story this morning. Shonali Basak there, our chief Wall Street correspondent. Coming up, your trading diary. What a week ahead we've got for you. Coming up to 26 minutes into the session, just about positive on the S&P 500 here. It's a mixed session. We're down about 0.2% on the NASDAQ. Big week ahead for the NASDAQ. Here's your trading diary on the week ahead. You'll hear from the president twice today. First at 12:30 Eastern, then again at 2:15 this afternoon. Big tech earnings kicking off with Alphabet and Microsoft on Tuesday. A Fed rate decision and Chairman Powell news conference Wednesday. US GDP and jobless claims on Thursday, followed by earnings from Apple and Amazon. And we round out the week with PCE, the ECI, University of Michigan Consumer Sentiment, and all of the above. From New York, thank you for choosing Bloomberg TV. Looking forward to the week ahead and covering that with you. This was the Countdown to the Open. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Monday, July 25th. Here are the top market stories we're following for you at this hour. Place your recession bets. Treasury Secretary Janet Yellen sees no sign of a U.S. recession while Wall Street debates a hawkish Fed, the economy, and rate cuts. Earnings cracks versus earnings resilience. You got big tech on deck as companies face down a stronger dollar, lower earnings estimates, and weakening consumer demand. We're going to get you covered now with Mark Lehman of JMP Securities. And over in Europe, it's planes, trains, and automobiles. German IFO data show the country teetering on recession. We bring you the latest breakdown earnings from Ryanair, plus a big CEO change over at VW. From New York, I'm Alex Steele with my co-host in London, Tom McKenzie. Guy Johnson is off today. Welcome to Bloomberg Markets. Tom, as we come in on this Monday, I feel like it's like, who's going to hit recession first? Where are the fears being more placed? Where you are or where I am?
I would make the argument, you look at the data here, and it certainly seems that Europe is going to be hitting the recessionary skids sooner than the US. We had that PMI data out last week that came in weaker than expected. And then you mentioned that IFO sentiment survey out of Germany. We spoke to the president of that survey, and he said, look, we are now on the brink in Germany of a recession.
Yeah, and I think it depends on how much is actually wind up pricing in. Here in the U.S., we're now pricing in some rate cuts now. The sooner you hike now, then you'll have to cut later. And that whole mentality sort of in the bond market with this bear steepening that we see.
Yeah, absolutely, and you're seeing that play out again across the bond markets today. In terms of what's happening with the Fed then, as we look ahead to that 75 basis point hike that is expected, of course, later this week at that reserve meeting. Let's take a listen to what we've been hearing.
Go everywhere and use every lever we can to bring prices down, but to do so in a way that doesn't have to give up all of the economic gains that we've made.
I think there is a likelihood that the third and fourth quarter will be quite back. Maybe the economy will stagnate, but it might also fall into a recession.
The big question is, will we have a recession or not? I think current signals are no. There might still be a soft landing, but you never know. The percentages change fast.
The alternative, to let your foot up off the brake, that's a recession for prolonged pain, making the agony longer and longer, stretching out over years.
Okay, so let's get to the question of the day then. And what are your recession odds? That is the question of the day. What are your recession odds? Let's bring in Bloomberg's Michael McKee and Katie Greifeld for the views on this as we lead up then to that Fed decision. Mike, let's start with you. 75 basis points seems to be being baked in at this point, but is there a risk that the markets are underestimating the possibility at this point of 100 basis points from the Fed? And take us through where that leaves us as we look towards the end of the year.
I don't think they're underestimating it at this point, because most Fed officials who spoke before the meeting and after that CPI report came out that sort of got the talk of 100 basis points going, they all said 75, and there's been no surprise newspaper article today that suggests that maybe they are rethinking that. There are also some indicators that have come out recently in the Philly Fed, the Empire New York survey, that suggests that some inflation pressures have rolled over and started to fall. Of course, we've seen the drop in gasoline prices here in the United States. So I think what you get is 75 basis points, and then Jay Powell comes out and says, we aren't sure what we're going to do in September. It's going to depend on the data. We're going to watch that closely. If the trends in inflation continue to drop, then the Fed is likely to keep going with interest rate increases for a while till they get to what they think is neutral, but not 75 anymore.
Yeah, referring to the Wall Street Journal, of course, which typically then has the ear to the Fed, is what you're referencing to, Mike. Hey, Katie, if you take a look at what the market is currently pricing in, like, what are your recession odds? Like, where are we in terms of the actual equity market, say, versus the bond market?
Should we talk about the yield curve? Okay, let's do it. So if you look at the 2s-10s curve, I mean, when it comes to the yield curve and recession prediction odds, there's a lot to fight about. There's also a lot to fight about which yield curve you look at, but the 2s-10s curve, I mean, it's very firmly inverted. We're looking at about 19 basis points of inversions. The 5-year, 30-year, it's not there yet. The 3 3-month, 10-year not there yet either, but the direction is clear. You have yield curves flattening all over the world. And even if you don't believe in the predictive powers when it comes to recession, I mean, the message that the market is sending is clear, which is the Fed is going to hike a lot, 75 or 100 basis points, who knows, but they're going to hike a lot. That's keeping the front end elevated. That's going to come at the expense of growth. That's why you're seeing that bid into the long end, relatively speaking. You add that together, I mean, that's an inverted yield curve, and that's what's playing out in the equity markets too. If you look in the S&P 500, still down 18% from the highs.
Yeah, and that inversion, we're seeing that again today with the 2 years at 3%, the 10 years at 3.82. Mike, just bring you back in here at this point. You talked about that inflationary risk, of course, and how you may start to see a Fed that eases off if inflation continues to subside, at least around the edges. The recessionary risks, though, what is your sense of the determination of this Fed to look through that weaker economic data to get back to that level, whether it's 2%, 2.5%, 3% that they see is adequate when it comes to the inflationary picture for the U.S.?
I think they, at this point, think they are still stimulating the economy. They're not at neutral, so they're willing to go as far as what they consider neutral, maybe 3% or a little above, and see what happens. You look at the indicators there that suggest that there's no real major inflationary outlook except for the survey of economists. The New York Fed's numbers, which are based on the yield curves, and the NBER don't see it happening at this point. So we don't know. The Fed doesn't know. They'll start to take it more carefully to make sure they don't push us inadvertently into recession. But you'll have to wonder, and to Katie's point, Thursday we get the GDP number. Suppose it comes in negative, and that's 2 quarters of negative growth, and a lot of people like to think of that on Wall Street as a recession. Does then the bond market react and the 2-year drop, and then the yield curve is less or not inverted?
Yeah, and that's also the confusing point, Mike, too. If I take a look at WIRP, the function WIRP that shows, potential rates, cuts or hikes from the market, we're looking at now a rate cut in February of 2023. So I wonder if, the bond market now is doing the job for the Fed, but then if we start to price in rate cuts, then all of a sudden you have the long end continue to come down, which then hurts the Fed's ability to really get interest rates higher materially for a longer period of time. It's like this circle that doesn't end.
Yeah, the Fed has to try and do its best. It doesn't know where the economy is going. This is a particularly unusual time for all this to be happening because we don't have specific problems that the Fed can watch the indicators like an inventory overbuild and try to work its way down. They're juggling so many different things at this point that the best they can do is say, we're going to focus on inflation. We're going to try to get that down. If that starts coming down, then maybe they don't need to go as far with interest rates and they can see whether they need to cut or not. The question is, are the markets getting out too far ahead of themselves? We won't know that for a while either. Nobody's going to know. That's the problem.
Katie, when it comes to these equity markets, this performance that we've seen since about mid-June, something of with a big question mark over it, at least some describe it as a bear market rally. Whatever you describe it as, the uptick that we've seen across the equity space globally just since about mid-June, and how you fold that into this conversation around the Fed, interest rates and the inflation outlook. How concerned are you that this is starting to fall apart?
It has been curious to see that bounce, whether it's a bear market rally, a dead cat bounce, whatever animal metaphor you want to use there. It is coming into an earnings season that many have said that you're going to see a lot of pressure beyond what sort of the headline estimates suggest. And this is the busiest week of earnings season. We have over $17 trillion of market cap reporting this week alone. And to fold it into the conversation we're having sort of about recessionary odds, I think it's going to be very telling to listen to what companies are actually doing. I mean, if you look just in the past couple weeks, Microsoft, Google, Lyft announcing layoffs or hiring pauses, just signs of a recent trend when you think about Amazon back in April warning that they were overstaffed. In terms of what C-suite executives think and what they're actually doing, that's sort of how recessionary fears become self-fulfilling if it does result in layoffs.
Yeah, and you have initial claims, slightly moving higher as well. All right, guys, thanks a lot. Good conversation to kick us off on this Monday Bloomberg. So Michael McKee and Katie Greifeld, thank you. And tune in Wednesday for our full coverage of the Fed's decision and Jay Powell's news conference that starts at 1:30 p.m. New York time. Coming up right now, looking at those odds of recession. It's more of our question of the day with Lisa Erickson, U.S. Bank Wealth co-head of Public Markets Group. This is Bloomberg.
Everyone's looking for another rate hike this Wednesday.
Central banker is basically going to take a sledgehammer to inflation.
But will the Fed be able to steer clear of a recession?
We've got inflation, we've got a bit of a weakening labor market, and we have concerns about recession.
Trust Bloomberg for the fastest coverage and exclusive analysis.
This year's people that are calling for inflation peaked are last year's people that called inflation transitory.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
We're likely to see some slowing of job creation, but I don't think that that's a recession. A recession is broad-based weakness in the economy. We're not seeing that now.
Fine line there. That was U.S. Treasury Secretary Janet Yellen with her outlook for the U.S. economy, which takes us back to the question of the day. What are your odds of a recession? Want to ask Lisa Erickson, U.S. Bank Wealth Management Senior Vice President. Lisa, what are your odds?
Well, Alex, we are seeing hopefully a avoidance of the recession in the near term, and it's really just based on the fact that we came into the year with pretty healthy consumer and corporate financial strength. That being said, as we look through the year, we also recognize that there are a lot of two-sided risk, as you have been talking about. Policy is tightening here with the Federal Reserve and with central banks globally, and we still have elevated inflationary pressures. And so with that kind of backdrop, again, there is going to be a growth slowdown. And so I think the bigger question becomes not just in the near term, but longer term, how that trajectory will be evolving. And with that, we are seeing a more cautious stance, even though, again, maybe in the near term, we believe that we're going to narrowly avert a recession here in the next few months.
Lisa, the dot plots, of course, looking to 3.4% by the end of the year. What does that do to those corporate balance sheets and to those household balance sheets? A level of 3.4% or thereabouts. How much of an erosion will that be to the strength of that cash that's on hand?
Well, as you know, the interest rate situation is definitely tightening, and that makes it more difficult for corporations to continue to manage their earnings and to manage their financial strength. We are seeing, however, when we look at the levels of financial strength indicators, that really the corporate sector is generally on fairly solid ground. And so in our mind, it's probably more of a question of really their appetite for spending going forward with the business environment being less certain, as opposed to in the near term, any strong risk from severe corporate weakening.
Lisa, I get the whole idea that we might narrowly avoid a recession within the economy. For earnings, do we avoid an earnings recession? I'm trying to really figure out if all the bad news is finally baked in, or we have to really lower 2023 estimates, and that's not yet reflected.
Corporate earnings, as you point out, Alex, are also very key. And what we see here are the same pressures that we're seeing on the economic front, that while, again, we came into 2022 on pretty strong footing, they are facing a number of pressures, whether it's from waning demand as well as elevated price pressures. And we're seeing that really start to come through in terms of second quarter earnings results, where, again, we are seeing some weakening of the reports with more mixed reporting across the universe. And so we are carefully monitoring what happens with those earnings. Again, similar to what we see on the economic front, we are still seeing some continued ability to have resilience, but we want to watch that trajectory as we move forward.
So there is some still ability around that resilience then in that corporate space. Where are you finding pricing power, Lisa? Where are margins still holding up at this point?
Well, certainly that's been tough across the board, but we are seeing, for example, in the consumer discretionary sector, where even despite many of the challenges that have been facing on the retail front, that those earnings actually are coming in better than expected. And so there are pockets, again, depending on the specific company and the industry, where there are some signs, again, that companies are managing to hold their own. But again, as we have quite a few earnings reports into this week and the following week, those will really begin to cement the picture to a greater degree.
So Lisa, I feel the vibe I'm getting for you is sort of a cautiously optimistic one. What do you do then with stocks and bonds in that environment?
Overall, we are more defensive right now. Again, while in the near term we see some of that underlying fundamental strength that we came into the year as preventing the worst case scenarios, we do recognize that there are many headwinds. And so we are modestly cautious, advising our clients to move all other things being equal, away from equities and more to quality fixed income, where again, historically, they've been able to hold up in times of market volatility.
Quality fix. Is there still value in that space though, Lisa? That's a call we've heard from a number of our guests over the last few weeks, in fact, the last few months. Is there still value within the high end of fixed income when it comes to the quality within that space?
Well, to your point, with interest rates rising, that impacts not only equities, but also the fixed income front. But nonetheless, what we see on a relative basis is that when you look across asset classes, even though we may still have the headwinds of, again, increasing interest rates and tightening Fed policy on that fixed income market, we believe it makes sense to have relatively more within that sector right now, again, just to provide some ballast to portfolios.
And Lisa, as we kind of wind this up here, do you think that the markets are complacent about inflation now, or do you think that there's still an opportunity, a cheaper opportunity to hedge yourself?
Well, overall, what we see with the inflation front is, again, elevated price pressures. And while our base case is that over the next several months, that should generally begin to move downwards simply because of very tough base comparisons from last year where, again, it's hard for those price pressures to continue at certain levels. We do see a level of uncertainty as to how quickly those will come down over time. So our belief right now is, again, just to recognize that in terms of more defensive positioning on your overall asset allocations and focusing on that stock bond mix as opposed to trying to manage outright other inflation hedges.
Okay, Lisa Erickson, thank you very much indeed, of US Bank Wealth Management Opportunities in investment grade credit, and of course that focus on the balance sheets of households and corporates. As Alex said, cautiously optimistic there. Okay, coming up, that bill to aid the US semiconductor industry is probably headed to a final vote in the Senate later this week. More on a busy week in Washington. That is next. This is Bloomberg.
And Gordon.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Angel Feliciano. The National Football League is betting that cable TV cord cutters will pay to watch certain games on mobile devices. The league is launching its own streaming service called NFL Plus. In addition to live games, it will feature shows from the NFL Network and archives of NFL films. The prize, $4.99 a month or $39.99 a year. The investment bank founded by billionaire Ken Moelis is starting a group to focus on global blockchain deals. Moelis & Company is beginning its effort in the middle of a so-called crypto winter. Venture funding in the industry has tumbled. Meanwhile, the price of Bitcoin has plunged to less than 1/3 of its record high of more than $68,000. And it's a big win for Intel and for Washington's goal of increasing semiconductor production at home. Intel has secured one of the biggest customers yet for its year-old contract chip-making unit. It will make chips for the Taiwanese company MediaTek, whose chips are used in Amazon's Echo speakers and Peloton's exercise bikes. And that is your Bloomberg Business Flash. Alex?
Right. Angel, thanks so much. Appreciate it. So let's stay on chips. Over the weekend, U.S. Commerce Secretary Gina Raimondo spoke with Margaret Brennan on CBS Face the Nation, pushing for the passage of the CHIPS Act.
Right now, we are dangerously dependent on other countries, mostly in Asia, for our supply of semiconductors. We don't make any leading-edge semiconductors in the United States, and those are the sophisticated chips that you need for military equipment and high-end computing. We buy almost all of them from Taiwan. So the reality is we need companies to expand in America, and other countries all around the world are providing incentives.
And that's just one thing on the docket. The Senate has a really busy schedule before those lawmakers leave for summer break on August 5th. Bloomberg Washington correspondent Emery Hordern joins us for more. Emery, the list for the Senate is so long. Can they actually get it all done? Like, what comes first? Can the CHIPS Act get done?
Well, the CHIPS is definitely going to come first. There's going to be a cloture vote today, and then leadership says it's likely going to pass sometime this week. And then I'll go over to the House, where it's also expected to pass as well. So, and the president's going to give a speech about it virtually, of course, today, because he is still quarantining. Secretary Raimondo will be there. A number of executives from the industry will be there as well in this push and momentum to making sure they can get that over the finish line. But Alex, the fact that you're talking about this long list in the Senate, it just got more complicated about an hour or so ago, and we found out that Senator Joe Manchin, a Democrat from West Virginia, has tested positive for COVID. In the Senate, you need to be present to vote. And there are a number of issues on the docket, like they want to do reconciliation for Medicare provisions and things like that. They are going to need his vote. So this has complicated an already complicated time because they're trying to get a lot in before, of course, they all go on August recess.
Anne-Marie, I'm just trying to get my head around the fact that you have to be physically in the Senate to vote at a time of COVID and Zoom and everything else. That baffles the mind. Anyway, on the case around Pence making a speech later this week, and Trump as well in D.C. How are both of these big players positioning themselves?
So Pence we're going to hear from tonight, and then the president tomorrow. And it comes at a very interesting time, of course, because we just had one of those final hearings of the summer from the January 6th committee, which showed that the president was silent while there was the assault on the Capitol, and then he was tweeting that Mike Pence didn't do his job, and there was chants from the crowd, death chants from the crowd about the president's former vice president, Mike Pence, and he is going to be speaking tonight. Really, it's going to be about trying to put the past behind them and look forward to plans that the Republican Party could deliver for the American people. And then President Trump will speak Tuesday night. And President Trump is the one, though, that wants to really live in the past, right? And he constantly, still to this day, talks about how the election results were rigged, which has been completely unfounded. So you have two of these individuals, and obviously everyone is going to look to see if there's any sort of statements towards 2024, because they both flirted with potentially running for president.
Anne-Marie, is anyone reconsidering this potential Pelosi visit to Taiwan, given the pushback we're seeing from Beijing?
Well, the president had said to reporters that the military did not think it was a good time for her to go. And what you're seeing from Beijing this morning is more fiery rhetoric about Speaker Pelosi's potential trip. Now, we don't know if she's definitely going there. She does have a trip scheduled for Asia, and there was going to be a stop in Taiwan. And what the Chinese are saying is that they are preparing for this and that they are using a lot more harsh rhetoric. But Tom, you and I spoke about this earlier today. Is that really China incredibly worried about her visiting Taiwan? Yes, he'll be the first Speaker of the House to go in some 25 years. But at the same time, this could be a deflection of Xi Jinping. He has a huge moment coming up in the fall. At the same time, he is dealing with another laundry list of economic issues, COVID-19, youth unemployment, you name it. So it's an interesting gamble right now.
It is a gamble. There's inherent risk in this move if indeed that trip goes ahead. Anne-Marie Jourdain, of course, always grateful. Thank you in DC. Stay with us. This is
Some breaking news for you. Gazprom is halting one more Siemens turbine at Porto Valle. That is northwest, about 95 miles northwest of St. Petersburg in Russia. So the Nord Stream flow from there is now going to drop to 33 million cubic meters a day starting July 27th. You're seeing Dutch gas prices rally on that news. It's again the constant reminder that Gazprom flows are not reliable, putting upwards pressure on gas prices. And also this week, as a reminder, there's one more part that is needed to repair Nord Stream 1 and to lift that gas supply to Europe, and that that may be shipped to Russia midweek. But again, question marks continue to remain, boosting energy prices over in Europe. All right, we're about 1 hour into the trading session here in the U.S. NASDAQ 100 right around the lows of the session, down by 0.8%. Kriti Gupta is here with the details. Kriti?
Yeah, a little bit of a marginal move when it comes to the benchmark indexes here. The S&P 500 really up only, or I should say down 0.1%, even when it was up earlier in the session. Once again, not that major conviction buying that we were probably hoping for, at least the bulls were hoping for. The underperformance, as Alex said, is going to be crucial here in the NASDAQ, especially because we're going into earnings season. And we're going to kind of circle back on that theme. But look, check this out. Even that risk appetite that you potentially see cross asset, even in the crude space, it's not that strong, up only 0.8%. Even the dollar is perhaps a little bit weaker. Once again, I think the theme of the day here is there's no real direction, no real conviction in any particular direction, which brings me to the earnings story, because that seems to be the kind of big game changer this week at a time when you have 75 basis points priced into the market from the Federal Reserve. But take a look at this. It's the earnings story that could go any which way. Remember, a lot of investors are looking for signs of recession, signs of slowdown, so the stakes are certainly high, especially for those mega weight technology names. Remember, Alphabet and Microsoft report tomorrow, kicking off the earnings story, but you also have the likes of Coca-Cola, McDonald's, for example. That dollar story that we've been talking about for ages, that's going to show up perhaps tomorrow in reporting in the pre-market. So really hold on to your hats for that. Let's also talk about perhaps one of the intraday stories, though, and that, of course, is what's happening over in China. They're talking about perhaps cutting or limiting some of that production capacity as, once again, they deal with yet another COVID outbreak in Shenzhen, where a lot of the technology production is really based. And what they're doing is perhaps enforcing a closed-loop system for some of those tech names. And that's where you see where a lot of these chip devices that have that for those production facilities in that area, you can see them falling under that kind of pressure. We're going to end here with the story on commodities, because there is an inverse correlation at play that we should be talking about that's really been at play all year long. Gas prices, as you start to see them come down, the stock market comes up. It is too early to say whether if this is really a kind of very close correlation, but it's something you certainly want to watch as we talk about inflation and whether or not inflation has peaked.
Yeah, particularly on a day when Dutch gas prices are elevated by about 9% on the back of that decision by Gazprom to pause one of the turbines. Kriti, thank you very much indeed. Let's get back then to the central bank world and, of course, the Fed. Chair Jerome Powell and his colleagues are expected to approve another 75 basis point interest rate hike this week, and they are likely to signal their intent to move higher in the months ahead. Joining us now is Tiffany Welding, PIMCO's chief US economist. Tiffany, good morning. Thank you for joining us. Let's start with the question of the day then from us and the team, which is, what are your odds at this point of a recession, as we note that data that's crossed the screen in terms of the terminal, the US July Dallas Fed Manufacturing Index falling by 22 to 22.6 versus an estimate of 17.7, just underlying the softness of the economic data that we're getting out of the US. What are your odds of a recession at this point?
Yeah, well, first, thanks for having me. So we think over the next 12 months, recession is more likely than not. And there's really three things that I would really point to supporting that view. The first, as you've mentioned, the economic data have clearly deteriorated lately. It's not just the data in the United States. Also, we've also seen purchasing managers' indices within Europe and elsewhere deteriorate to a point that is more consistent with a contraction in real growth. But secondly, we've also seen inflationary supply shocks that are worse than expected. Obviously, the geopolitical turmoil and the war in Ukraine have resulted in a bigger reduction in energy flows to Europe than we had previously expected. That sort of supply shock is going to have stagflationary pressures for the global economy, including the U.S. And then just finally, within the U.S., inflation is looking more persistent. Wages and housing and shelter inflation. So that just means the Federal Reserve is probably going to have to go higher and maintain more restrictive policy for longer to bring that back down.
So, Tiffany, would you be protecting against inflation now or a recession now? Which one should investors be focusing on first?
Well, I think that, one of the things that's kind of interesting about this recession that's going to be quite different from more recent recessions that we've gotten over the last, call it 20 years, is that this recession is going to be characterized by high inflation. So there are implications to that. And one is just the counter-cyclical response that we get from both monetary and fiscal authorities is going to be quite different to a recession this time. They're not going to be able to accommodate a recession like they have in the past,
past. So what does that mean? Well, it could mean that we might have a shallower recession, but it could be more prolonged, meaning that we get several quarters of kind of a slow contraction, but then ultimately gives way to sort of subpar, below trend growth for quite some time until we are getting inflation that's more consistent with the Fed's mandate.
Where would that scenario then, Tiffany, leave the U.S. jobs market?
Well, ultimately, the jobs market is going to deteriorate. We would expect you to get increases in the unemployment rate, as well as negative month-over-month job gains. And we've already seen, various indicators that tend to lead the job market, really start to deteriorate and suggest the unemployment rate is going to move up. I think the Federal Reserve is also preparing for this. You saw in their latest summary of economic projections that they were even expecting the unemployment rate to move up. We think that it moves up a little bit more than they do as a result of a view of recession, but certainly the labor market is not going to be immune to this. And one other thing with that is keep in mind that if you are trying to cool off the economy, one of the channels with which you do that is to slow aggregate income growth, slow the labor market, actually unfortunately have people lose jobs. That's the blunt tool that the Federal Reserve has to get inflation back down.
Now, Tiffany, what is so perplexing me is how much investors are trying to front run all of this. And the way it occurs to me is that the Fed's going to want higher rates to cool down the economy and tamp inflation. Yes. If they talk up those rates, then the fears of a recession happen, and then the rate cuts start getting factored in, which then dents the rise in rates, which then affects what the Fed can do. I just don't understand how this is going to wind up working.
Yeah, I think it's a very good point. And just to answer that, I would point to the fact that the Fed and monetary policy works through a broader range of financial conditions than just interest rates. And that includes, equity prices as well as the dollar and credit spreads. And so, you have to think about that broader range when you think about how tight monetary policy is. And in this kind of environment, although you might have recession risks that are weighing on Treasury yields and keeping them down, in that kind of environment, you probably have higher equity risk premiums. You could have the dollar, that's also benefiting, appreciating from flight to quality flows, and those things will tighten financial conditions as well. So overall, we would argue you probably are going to get continued tightening in financial conditions more broadly, although that might not mean that rates, at least longer-term interest rates, continue to rise.
So just to unpack that a little bit, Tiffany, in terms of the yield spread, and how yields move, as we look into the early part of 2023, on the back of this rate hike trajectory, do you see yields being capped at the levels they are? How much more further? We're seeing a lot of action towards the back end at this point. The front end is a little lower now. And that, of course, inversion that we're seeing between the 2s and the 10s, is there a point where things start to adjust?
Well, ultimately, I think what the market is telling you is that the market expects the Fed to be in restrictive territory. And that's why you're seeing that inversion where the short-dated interest rates are somewhat higher than longer-dated interest rates, depending on, what points on the interest rate curve you look at. And we would agree with that. And I think the Fed has also suggested that they need to bring monetary policy into restrictive territory. Now the actual level of any given interest rate will be impacted by many different things. We kind of lump those together, call it term premia. But so I think that the thing that we should be watching right now is more the interest rate curve. It has been a good predictor of recession in the past. Of course, when it's inverted, it has suggested or foretold, a recession that is going to come.
Tiffany, what would be restrictive in terms of interest rates? Like, are they going to go to 4, higher? How long do they stay there?
Yeah, I think that is a key question that's being asked, because not only do we not really know how high we need to be, how restrictive we need to be, but there's also some question about what exactly the level of interest rates would be consistent with neutral policy. So either neither expansionary nor contractionary. I think the one thing though that is clear right now is that 1.6 on the federal funds rate is not only not neutral and not restrictive. It's not only not restrictive, but it's not not neutral. So the Federal Reserve, in our minds, at least needs to get policy to neutral, at this point. And I think that's why we've seen these outsized adjustments that they're going to deliver. And of course, commentators expect another 75 basis points at this meeting this week. We think it could be more, just to get policy back up to neutral. And so, it does look currently at a sync with economic fundamentals. There's a lot of questions around how the economy will start to react because monetary policy works through lags. So we have to start to see how the economy reacts to the rate hikes that we've already gotten, in order to really gauge how high is restrictive that'll be necessary.
Tiffany, really appreciate it. Great analysis. I don't envy your job right now. Tiffany Wilding, PIMCO U.S. Chief Economist. Thank you so very much. Let's get back to the breaking headlines that we got earlier here. Gazprom is halting one Siemens turbine at Portovaya that is 95 miles from St. Petersburg in Russia. Gazprom has asked Siemens for clarification on some issues. They did receive the turbine papers, but now they still have questions. That's going to limit gas flows from that region, and it's going to drop to about 33 million cubic meters a day, and gas prices definitely moving higher. European gas prices up now by about 10% on the day. All right, coming up here in the U.S., it is all about big tech. Some of the biggest names coming out this week: Alphabet, Microsoft, Meta, Apple, Amazon, you name it. We're going to speak to a CEO of a firm that specializes in investing in tech. Mark Lehman of JMP Securities is next. This is Bloomberg.
Keeping you up to date with the news from around the world, here's the first word. I'm Angel Feliciano. Elon Musk is denying he had an affair with Sergey Brin's wife. According to the Wall Street Journal, the alleged affair took place in December. The newspaper says it led Brin, the co-founder of Google, to sell his investments in Musk's companies. Musk says the story is untrue and that he's still friends with Brin. Brin filed for divorce from his wife in January. China said it was getting seriously prepared for the possibility that Nancy Pelosi visits Taiwan in the coming weeks. That underscores the risk of a showdown between Washington and Beijing over a trip by the U.S. House Speaker. A foreign ministry spokesman indicated that China had issued stronger than usual warnings against the Pelosi visit. Now, Hong Kong reportedly plans to reduce hotel quarantine for arrivals. According to local media, a two-color health code system will be introduced. One proposal calls for 5 days of hotel quarantines. After that, arriving travelers would be issued with a so-called yellow health code for 2 days that would prohibit them from entering high-risk areas. And in California, a wildfire raging out of control near Yosemite National Park has forced thousands of people to flee their homes. It has now blackened more than 15,000 acres in an area about 170 miles east of San Francisco. Authorities say the fire is uncontained and has destroyed at least 10 buildings. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Alex?
Angel, thanks so much. It is the busiest week for big tech earnings this season, with over $6.5 trillion in market cap reporting over the next few days. Investors bracing for mostly bad news after Snap and Twitter earnings last week suffered from a pullback in online ads. Joining us now, Mark Lehman, CEO of JMP Securities, a Citizens company. Hey, Mark, you cover all things tech deep in the weeds. Have expectations re-rated enough, whereas a beat, a solid thing, stock rallies, or do we need to price in more downside to earnings?
Well, it's a perfect question. I mean, we had this extraordinary contraction in the first half of the year. The market seemed to find some footing at the beginning of this month, and then we had those earnings last week, which were obviously disappointing. So I don't know if we're in the Goldilocks phase where we were too cold and then we got a little hot, and maybe this is just right, and the companies just need to report. But I think we're going to see some wild swings this week, like we've seen each of the last 2 quarters after these big companies have reported. My sense is the market is kind of at equilibrium. That is, we've probably seen the lows in tech, unless we see something monumental, if we see another black swan event like we've seen. But this is obviously the biggest week for tech earnings for the second quarter, and we're going to learn a lot about the back half of this year, I think, as they guide to the rest of the year, which is what it's all about. It's the forward-looking guidance that I think is more important than the rearview mirror.
Okay, so we're looking at the forward-looking guidance. It sounds like we're going to have to hold on to our hats this week then, Mark. How much divergence do you expect to see within the tech space on the back of some of the fundamentals that are changing and affecting these corporates going forward?
I mean, I think you're going to see a great amount. I mean, we don't even talk about FANG anymore. I mean, when's the last time we saw the FANG acronym on your